Hello students, welcome to my channel Stream Commerce. In this video, we are going to study about accounting standards. Let us understand about the meaning of accounting standards. Accounting standards are basic policy documents. Their main aim is to ensure transparency, reliability, consistency and comparability of the financial statements. Which means accounting standard specifies how transactions and other events are to be recognized, measured, presented and disclosed in the financial statements. They are done by the accounting standard policies and principles of a nation economy. These accounting standards are issued by an accounting body or a regulatory board or sometimes by the government directly. In India, the Indian accounting standards are issued by the Institute of Chartered Accountants of India, which is also known as ICAI. Accounting standard deals with four major issues of accounting. First is recognition of financial event. Second, measurement of financial transaction. Third, presentation of financial statements in a fair manner. Fourth, disclosure requirement of companies to ensure stakeholders are not misinformed. Now let us study about the objectives of accounting standards. First is to improve reliability of financial statements. The main aim of accounting standards are to improve the reliability of financial statements. Now, because the financial statements have to be made following these standards, the users can rely on them. They know that not conforming to these standards can have serious consequences for the companies. Second, to compare the position of the firm. The accounting standards allows for inter-firm and intra-firm comparison. This allows to check the progress of the firm and its position in the market. Third, to provide one set of accounting policies. The accounting standards also looks to provide one set of accounting policies that include the necessary disclosure requirements and the valuation of methods of various financial transactions. Next, we move on to the benefits of accounting standards. First is attain uniformity in accounting. Accounting standards provides rules for standard treatment and recording of transaction. They even have standard format for financial statements. These are steps in achieving uniformity in accounting methods. Second, improves reliability of financial statements. There are many stakeholders of a company and they rely on the financial statements for their information. Many of these stakeholders base their decision on the data provided by these financial statements. Then there are also potential investors who make their investment decision based on such financial statements. So it is very important to present a true and fair picture of the financial position of the company. The accounting standards ensure this. They make sure the statements are reliable and trustworthy. Third, prevents fraud and accounting manipulation. Accounting standards lays down the accounting principles and methodologies that all entities must follow. One outcome of this is that the management of an entity cannot manipulate with financial data. Following these standards is not optional, it is compulsory. So these standards make it difficult for the management to misrepresent any financial information. It even makes it difficult for them to commit any fraud. Fourth, assist auditors. The accounting standards lays down all the accounting policies, rules, regulation, etc. in a written format. These policies have to be followed. So if the auditor checks that the policies have been correctly followed, he can be assured that the financial statements are true and fair. Fifth, comparability. This is another major objective of accounting standards. Since all entities of the country follow the same set of standards, their financial accounts become comparable to some extent. The users of the financial statement can analyze and compare the financial performance of various companies before taking any decision. Also, two statements of the same company from different years can be compared. This will show the growth curve of the company to the users. Sixth, Determining managerial accountability. The accounting standards helps measure the performance of the management of an entity. It can help measure the management's ability to increase profitability, maintain the solvency of the firm, and other such important financial duties of the management. Management also wisely choose their accounting policies. Constant change in the accounting policies lead to confusion for the users of these financial statements. Also, the principle of consistency and comparability are lost. Now, let us see about the limitations of accounting standards. First is difficulty between choosing alternatives. There are alternatives for certain accounting treatments or valuation. Like for example, stocks can be valued by LIFO method, or it can be valued by FIFO method or weighted average method, etc. So choosing between these alternatives is a tough decision for the management. The accounting standard does not provide guidelines for the appropriate choice. Second, restricted scope. Accounting standards cannot interfere the laws. They have to be framed within the boundaries of the laws prevailing at the time. That can limit their scope to provide the best policies for the situation. Now let us move on to the accounting standards. The Council of the Institute of Chartered Accountants of India has so far issued 31 accounting standards. Let us study about some of the important accounting standards. AS1 Disclosure of Accounting Policies. According to this standard, it states that a business needs to disclose significant accounting policies followed by it to prepare and present its financial statements. This is because a business entity's statements of affairs get significantly impacted by the accounting policies used in preparing its financial statements. Thus, a business mandatorily needs to disclose its significant accounting policies in order to present a true and fair view of its statements of affairs. For example, methods of depreciation, treatment of expenditure, treatment of goodwill, valuation of fixed assets, investments, inventories, etc. Next, we move on to the next accounting standard, which is AS2 Valuation of Inventories. AS2 is the accounting standard for the valuation of inventories and their accounting treatment. This accounting standard covers methods to value the inventory of a business and its disclosure in the financial statements. The general rule mentions valuing inventories, that is, closing stock of a business at cost or market value, whichever is lower. Next is AS3 Cash Flow Statement. According to this standard, it states that the cash flow statement should exclude the movement between items which forms part of cash or cash equivalent of an entity during a particular period. Such information is disclosed in the cash flow statement indicating cash flows from operating, investing and financing activities during an accounting period. Next accounting standard is AS6 Depreciation Accounting. Depreciation is defined as a continuing, permanent and gradual decrease in the book value of a fixed asset. This type of shrinkage is based on the cost of asset utilized in a firm and not on its market value. So according to this standard, the depreciation amount of an asset should be allocated on a systematic basis for each accounting period during the useful life of an asset. Next is AS8 Accounting for Research and Development. According to this standard, it deals with the treatment of cost of research and development in financial statements. Research is an original and planned investigation undertaken with the hope of gaining new scientific or technical knowledge and understanding. So, according to this accounting standard, the amount of research and development costs should be charged as an expense of the period in which they are actually incurred. Next accounting standard is AS9 Revenue Recognition. Revenue recognition is an accounting principle that asserts that revenue must be recognized as it is earned. This standard deals with the basis for recognition of revenue items in the profit and loss account of an enterprise. It lays down conditions to recognize revenues that arise from the various transactions of an enterprise. Next accounting standard is AS10 Accounting for Fixed Assets. According to this standard, the cost of fixed assets should comprise of the purchase price and any attributable cost of bringing the asset to its working condition for its intended use. The fixed asset should be eliminated from the financial statements on disposal or when no further benefit is expected from their use. Next accounting standard is AS12, Accounting for Government Grants. According to this standard, government grants should be recognized when there is an assurance that the enterprise will comply with the condition attached to them. Next accounting standard is AS13, Accounting for Investments. According to this standard, an enterprise should disclose the current and long-term investment distinction in its financial statements. Current investments should be carried in the financial statement at the lower cost of fair value. However, long-term investments should always be carried in the financial statement at the cost price. Next accounting standard is AS22, Accounting for Taxes on Income. According to this standard, tax expenses for the period comprising current tax and deferred tax should be included in the determination of the net profit or loss for the period. Next accounting standard is AS26, Intangible Assets. Intangible assets are assets which are non-monetary in nature and has no physical existence. For example, goodwill, patent, copyright, trademark, etc. According to this standard, it addresses how goodwill and other intangible assets should be accounted initially and subsequently in the financial statements. It also attempts towards recognition and proper valuation of the economic benefits generated by intangible assets. Because of this standard, the firms are now able to identify and value the intangible assets which were used to combine under the heading goodwill. So that's it for the video. Thanks for watching. I hope you have understood the accounting standards. If you guys liked my video, then share it with your friends and subscribe to my channel for more videos.